A major construction site demands immense, immediate capital. Before a single wall goes up, contractors sink millions into materials, heavy machinery, and labor. But running parallel to the physical assembly is an invisible, strictly regulated financial system. Every transaction carries a 15% value-added tax. On a typical retail purchase, that is a simple exchange at a cash register. In large-scale infrastructure, however, that operates as a complex chronological clock, tied to rolling contracts and delayed payments. Misjudging the mechanics of that clock is a fatal project flaw. If the timing of a tax liability misaligns with actual revenue, it can instantly drain a contractor's cash reserves. This is the VAT 409 Guide for Fixed Property and Construction. It details exactly how the standard rule of invoice and pay is warped for long-term builds. The moment a firm expects to make over 1 million rand in taxable supplies within a 12-month period, they cross the legal threshold and must register for VAT. Once registered, a firm enters a high-stakes ecosystem. If a contractor triggers a tax liability too early, they legally owe the Revenue Service hundreds of thousands of rands in output VAT, long before the client actually transfers funds into their bank account. Mastering the specific timing rules of construction VAT is the only reliable way to prevent this cash flow vacuum and keep a project solvent. Consider the timeline of a public school project. Long before excavators arrive, consulting engineers and architects begin billing for their initial design and survey work. The system operates on a subtractive credit input method. These architectural firms charge output VAT to the government client for their designs, while simultaneously deducting input VAT on the expenses required to run their own offices. Claiming those input VAT deductions requires strict legal adherence to the primary piece of documentary evidence, the tax invoice. A valid tax invoice over 5,000 Rand must include the words tax invoice, supplier and recipient details. Looking further down, it must feature a serialized number, date of issue, accurate item descriptions, and the exact value and tax explicitly broken down. If a single digit in the VAT number is wrong, or a recipient address is missing, the document is legally invalid. The firm immediately loses the right to claim that input deduction. Submitting flawed invoices and claiming invalid deductions is the first major trigger for a forensic audit from the Revenue Service. The physical timeline shifts to the main contractor breaking ground. Planning transitions into active, heavy capital expenditure as raw materials flood the site. The massive contracts governing this work, like JBCC or NEC3, operate under a specific legal concept known as a progressive supply. Because the work is completed in stages, the legal time of supply for VAT is entirely divorced from the moment a contractor merely asks to be paid. Instead, the exact moment VAT liability is triggered is strictly tied to the independent quantity surveyor's valuation of the work completed on site. The time of supply officially locks in only when the formal payment certificate is issued by the principal agent or when the contractor actually receives payment, whichever event occurs first. By carefully managing the timeline of these surveyor valuations and formal certificates, a main contractor effectively controls their legal liability to SARS. Real-world sites rarely proceed flawlessly. Frequently, a client will hold back a 10% retention fund to guarantee the quality of the final build. Tax law makes a specific allowance for this withheld money. The output VAT on that 10% is legally delayed and must only be declared when the retention is finally invoiced or becomes due at the end of the defect's liability period. Late completion penalties introduce another variable. If a builder misses their deadline, the resulting financial penalty functionally reduces the original agreed-upon contract price. To fix this mechanically within the tax system, the contractor is required to issue a credit note. This document officially adjusts their previously declared output VAT downward, realigning their tax liability with the new, lower contract value. Ignoring credit notes or prematurely declaring retention funds are precise financial pressure points that auditors target when reviewing construction firms. As the school project reaches practical completion, the entire interconnected financial chain becomes visible. This diagram illustrates the fundamental link. The output VAT paid by a subcontractor serves precisely as the input VAT claimed by the main contractor. The chain continues seamlessly upward. The main contractor's output VAT becomes the developer's input VAT, forming a complete project cash flow pipeline. If the paperwork or timing fails at any single node in this pipeline, the entire ecosystem paralyzes, freezing cash flow for everyone simultaneously. There is a common industry assumption that tax compliance is an administrative afterthought, best left to back-office accountants. The reality is that mastering these financial mechanics is an essential frontline project management skill. Signing off on a JBCC or NEC3 payment certificate without understanding its immediate tax implications is a blind gamble with a firm's survival. A successful build requires absolute precision with the physical blueprint and equal mastery of financial timelines. VAT is one of the most misunderstood systems in construction, yet it controls the cash flow survival of contractors and consulting firms.